Mark Zandi. He is the Moody's Analytics Chief Economist. Mark, welcome to Bloomberg HT.
It's so good to be with you. Thank you for the opportunity.
My first question is CPI report will be released on Wednesday. What's your expectation? Could the June CPI report change the Fed's rate trajectory?
Well, I'm feeling pretty good about the report. As you know, inflation is much too high, and it's been high for the past couple of years. It is moderating. It peaked about a year ago. It's moderating. And I expect the CPI number for June to show further moderation. So just to give you a number, I expect the overall CPI to increase by 0.2%, which would put year-over-year growth at just over 3%. And just again, for a bit of context, the peak was back a year ago. We saw inflation, CPI inflation of 9%. So we're moving in the right direction. I think the trend lines look pretty good. I'm hopeful that inflation will continue to moderate going forward. And there's some reasons to believe that will be the case. So I'm looking forward to that report. Having said that, I don't think that that's going to change the Fed's mind with regard to what it does at the next meeting of the FOMC, the Federal Open Market Committee, which is at the end of this month. The Federal Reserve Chair Powell has made it pretty clear that he expects the Fed to raise rates another 0.25 percentage point. And I think he'll follow through on that, almost regardless of what the CPI number says.
Right. Another economic data came up. U.S. labor market cooled off in June, adding just 209,000 jobs. What are your main takeaways from the June reports?
You know, I thought that was a pretty good report too. It shows an economy that's not too hot, not too cold. Not too hot would have been an increase in employment of over 300,000, and there have been some concerns about that. And that's kind of the average monthly job growth we've been getting for much of the year. Too cold would have been something closer to 0. So 200,000, that feels like it's right where you'd want it to be, slow enough that it's strong enough that it means that the economy continues to move forward, avoid a recession, but slow enough so that it'll allow inflationary pressures to abate and get that inflation back down close to the Federal Reserve's target. So, hard pressed to come up with a better number than the one we got last Friday for the month of June.
And Fed meeting is coming up soon. What's your expectation? Do you think Fed is on the right track? Is there going to be a interest rate?
Yeah, I think it's pretty clear the Fed wants to raise rates at the meeting at the end of July. So the federal funds rate target is going to go up another 0.25 percentage point, 5.25% to 5.5% range. If I were on the committee, I'd probably be arguing that this is unnecessary. In my view, the rate hikes to date, and there's been some very aggressive increases in interest rates over the past more than a year, will be sufficient to slow the economy down and bring inflation back to target in a reasonably timely way. It's not going to happen next month, not next quarter, but by this time next year, I would expect inflation to be pretty close to the Federal Reserve's target. So I'd argue for no rate hike. But having said that, markets have already anticipated the Fed rate hike. It's already embedded in stock prices and bond yields. So they simply follow through. I don't expect any meaningful change in stock and bond markets, and hopefully that'll be the end of it. I don't think they need to raise any rates any further, and hopefully they'll come around to that conclusion here relatively soon.
And another hottest topic is the artificial intelligence, and you have some remarkable statements on AI. How AI will change the job market, especially risk and opportunities for workers and employees?
Yeah, artificial intelligence does pose significant risks and opportunities to workers. Hard to know how that's going to all play out here over the near term and longer run. My sense is that on net, AI will be a plus, that it'll increase labor productivity, and goodness knows, the U.S. economy needs stronger productivity gains, given how tight the labor market has been and how difficult it will be going forward to find workers, given the aging out of the workforce by the baby boom generation and in weak immigration. And the economy needs new technologies to advance the productivity ball here. And I think AI will be a very important source of productivity gains. Yeah, now, clearly challenges as well. Certainly for certain industries and workers in certain occupations, we will see people lose work and jobs, and there will be some dislocations in the labor market, some adjustments that will have to occur. So it'll create some pretty significant winners and losers. But I think when it's all said and done, it'll be a net win for the economy. One other thing I'll say is I do think it probably is all going to play out over a longer period of time than is widely expected. I mean, if you look at history and other technologies that have been introduced into the economy, it takes a while for those technologies to be embedded in business practices and to have an impact on productivity in the broader economy. And I think that likely will be the case with AI as well. We can see it, we can feel it, it's coming. We all know that, but I think it's just going to take a little bit longer than most people anticipate for it to really have a significant impact on the broader economy.
And my last question is, Secretary Yellen was in China, and she said the trip has been successful. What do you think about Secretary Yellen's trip? What is your key takeaways, especially from the U.S. economic perspective?
I'm very encouraged by the trip, much needed. I mean, the U.S. and China relationship, economic relationship, geopolitical relationship is, if not the most important, among the most important in the world, critical to global economic growth. And it doesn't make a whole lot of sense for anybody for these two large economies to be battling each other and working at cross purposes. So I think it is a good positive development that we're now talking again and trying to work through a lot of the issues. And goodness knows there's issues. You know, there's issues around trade practices and intellectual property, on cybersecurity, on investment patterns. So a lot of things to debate, argue, work through. But I think it's critical that we're talking. The two nations are talking again and working together to solve the problems and the problems that we face. And we have enormous problems, that we're going to have to address. And we can't do that unless these two nations are, at least discussing the differences and working through those differences. And I'm encouraged by Secretary Yellen's trip there. I think that's a good step in the right direction.